order. And the first item would be the approval of the minutes. Councilmember Jurinsky, have you had a chance to review them?
Yeah, I approve them.
Okay, I had one small change on page 3 because I kind of don't make sense. It says when you set the university, blah, blah, blah. I really don't even know what it's supposed to be, but I think it might be when you see the university, because we were looking at a map. And it should say fall into the TIF. But do they fall into one of 3 metro districts?
Councilmember Bergan, who was the speaker?
Me.
Okay, so it was, okay.
Yeah, it's on page 3, and it was my question about the university, but I think it should be, I don't even know what it should be, but like maybe when you see the university, obviously they fall into the, and I think that's supposed to be the TIF, but do they also fall into one of the 3 metro districts?
Okay, we'll go back and re-listen to that and make the adjustment if you're okay with that.
All right, thank you very much. And then we'll go ahead and move on to consent items with the sales tax chart. Bill, do you want to go ahead and talk about that? Or Greg?
You know what? I accidentally let Bill go on vacation. So it's actually going to be Kirsten that's going to be talking about it.
Oh, okay, great.
Good afternoon, Council. I'm Kirsten from the Budget Office. Sales tax revenue grew by 3.7% in February, which compares to year-over-year inflation of about 6%. So we are seeing some softening in the revenue numbers. In fact, most of the growth was driven by a single company last month. The good news is that the 2023 budget assumed 3% growth in sales tax revenue, and year-to-date collections are still ahead of this assumption. Do you have any questions?
Member Jurinsky?
Yeah, I do. That single company, is that Amazon?
It's in the utility sector.
And generally, Councilmember Jurinsky, we don't disclose the names of the taxpayers since that's confidential data.
We could probably guess who it is, but okay.
Yeah.
Amazon online sales is still seeing relatively good growth in general compared to a brick and mortar growth.
So we don't have any concerns that it was lower than our trend has been?
We're watching it.
Yeah.
We would rather it be above inflation, but it's not necessarily surprising that it's below. And it's only a month. Last month was better.
Right.
Councilman Jurinsky, did you have anything further?
Yeah. So what does our brick and mortar sales growth look like?
I would have to look through the data to give you actual numbers. I have not pulled that. Also, some of we don't have clear data because some of our we don't ask companies to split their data between online sales and brick and mortar sales. So we do have some companies that we know are only online, and we track those. But there are, in what we consider like brick and mortar, also includes some online sales because we don't differentiate every company between online and brick and mortar.
And we can provide you some. We'll be able to get some information to you.
Are you good?
Yeah.
Okay. All right. Thank you very much. And then we'll just go ahead and move on to general business with the presentation on the spring supplemental.
Hey, there I am. It did work. Hi, I am Jackie Amon from the Budget Office. And even though you see me here bringing you the spring supplemental, just want to note that there are a lot of people on this call, and all of them had a hand in bringing this to you. So even though I'm here, a lot of people worked on this, and I want to thank everyone for their hard work on this supplemental. I'll be giving you some highlights of the adjustments, the final adjustments for 2022 and the initial adjustments for 2023. For 2022, we also have good news, and that is that all the items that impacted the general fund were either projected and included in the 2023 budget plan, which makes us happy, or they were technical and had no impact to the fund balance. There is one general fund item I'd like to note for 2022. And although a transfer to the risk fund to keep the fund balance healthy was projected, the amount of the transfer turned out to be more than expected due to the year-end actuarial adjustment. More details on this were included in the supplemental narrative, and Greg will also be going over what we see in the risk fund at the spring workshop coming up in April 29th. For all other funds, most items were projected or reviewed by council at a committee or council meeting. There are several technical items as well in other funds. I should also note that although an overage was projected for the development review fund, it was more than expected. This is really a timing issue with purchase orders for contracted services impacting the budget late in the year, and so therefore they were not included in the projection. So moving on to 2023, there are several technical items as a result of operational realignments where we're moving budgets from one organization to another. Other technical items include the appropriation of grant funding, creating transfer budgets by using existing appropriation, and reappropriating funds that were not able to be spent in 2022 due to timing. One item in 2023 that really jumps out due to the significant amount is the appropriation of both grant and city funds for the I-70 Piccadilly project. We did provide attachment E in this packet, which is a chart that was previously reviewed by council, outlining the funding of this project holistically. Because what you see in the supplemental are only pieces. Significant items to note in the general fund include ongoing requests to add 9.5 FTE and 7 variable hour positions in support of public safety. 6.5 of these FTE are in the police department, and the rest are in human resources for public safety recruitment and background services. And so, like I said, there are several people here, and if you have any additional questions we didn't answer for you in the narratives, we're here to answer your questions.
Councilmember Jurinsky, do you have a question on that?
Well, I just can't get anything to open up in eScribe, so I can't even get the agenda open or see what was put in the supplementals for this.
Yeah, it's not in eScribe. I tried. I had to go
Oh,
to the
how'd you-
website.
oh, okay.
But I have a question on the FTEs. So 6.5 were police, and then so the remaining were HR positions?
Right, 3 FTE were in HR for talent acquisition specialists dedicated to public safety. And then there are several variable hour positions being added to human resources for background investigations and other background services.
So, but we're transferring some of the background investigators from civil service over to HR as contract. Is that correct?
Yes, the ones added in HR are variable hour full-time. The ones transferred over from civil service are variable hour part-time. And Jason's here if you have any more detailed questions on that move or those FTE for police.
How about when are they in place, or we're still hiring?
Most of them are all so for the HR people, they're almost all here. If not all here, they're almost all here. For the police, there are a couple who are here, but most are being recruited for or are vacant.
Any other questions, Councilmember Jurinsky?
No.
Okay, go ahead, Jackie.
That's all I had to say, unless there are more questions.
Is Greg going to go into more on the supplement, or is that we're done with that one?
We're done.
We're done. She's got her handled.
I did have a question. I don't have it in front of me because yeah, it's not in eScribe, so you have to go to the other thing. But on the marijuana monies, now I can't remember what that amount was in there, but is that for the Day Resource Center?
There were 2 on the marijuana monies. There was one that was just adjusting the budget down to match revenue. And then there was another one where we were sort of swapping things between the general fund and the marijuana fund. Do you remember which one you were thinking of?
I should have written it down.
One of them, we were trying to consolidate all the FTE in the general fund. We had some scattered two or 2.5 in the, no, was it 1.5, Kirsten, in the marijuana fund? We decided to move them to the general fund to keep all the FTE over there. And we sort of swapped out some budget between those two for a net zero transfer.
Right. Historically,
So
there was some agency funding in the general fund, and most of the agency funding now happens in the marijuana tax revenue fund. So we wanted to keep those separate and clean it up a bit. But it's a net zero supplemental.
Okay.
Let's check it out.
But their FTEs going to general fund? Is that what you
Was
said?
there 1.5?
It's one FTE and one variable hour position
Okay.
that's moved from the marijuana tax revenue fund to the general fund. Yes.
Okay. All right.
So
And- but
now,
nothing-
so now all the FTE related to that project are in the general fund, and all of the agency funding is in the marijuana fund.
Okay. Oh, got it. Okay. All right. Thank you. All right. I think that's it on spring supplemental. We'll move on to the voter service polling.
Okay, thank you.
Council members, so this is an IGA that was originally approved by council for the 2020, 2021, and 2022 elections. This is an IGA with Arapahoe County for them to use city-owned facilities for VSPC locations and Dropbox center locations. So for the renewal of this agreement, it will be for the 2023 and 2024 elections. And again, if you'll remember, in November of 2022, we did approve to add 3 new VSPC locations that were city-owned. So those are also included in this new agreement. So basically, this is just an agreement with Arapahoe County for them to use our city facilities for certain dates to have VSPC locations.
What about Adams County?
So I believe Adams County, they have not sent us an IGA for use of any of our facilities. So the only one we have is for Adams County right now.
Okay, so the MLK is Arapahoe County, not Adams. I always get that mixed up.
Yes, council member, it's on the south side of the street.
Okay, okay, and that makes sense. Councilmember Jurinsky, do you have any questions on the facilities for election?
No.
Okay, thank you, Katie.
Okay, and then I'll be moving this forward to a study session and then a regular council meeting for approval.
Oh, okay, so we'll go ahead and move that forward. Thank you.
Okay, thank you.
All right, and then pre-audit letter, Nancy Mushmeyer.
Yes, hello, good afternoon. So at the beginning of every audit, our external audit firm, Forbes, they provide us with 2 different letters. First of all, the engagement letter, which they will provide during interim field work, and that usually takes place during the fall. That letter outlines all of the services that they're going to perform during the audit. They also outline the fees for those services. And then they talk about the responsibilities, both of the external auditors and then also the responsibilities of management and of staff. And then the other letter, this is the pre-audit letter, and it's provided during spring, right before the final audit field work starts. And this letter really outlines in a bit more detail the scope and the timing of the financial statement audit and the other audits. And it's this detail that they really gleaned that information when they were out here in the fall during the interim work. So that's why there's the 2 different letters. And so specifically, the pre-audit letter will go over areas where a higher level of risk in error has been identified, and then the auditors will talk about their procedures to combat that risk. And then they'll also talk about areas that you as the audit committee need to be particularly aware of. And these are really areas that are more material in nature. So they're usually higher dollar amounts. They may be areas that are a little bit more unusual in nature. And they also could be things that have an internal control risk. And then they specifically will call out in this letter the new accounting pronouncements that we have to implement with this audit. And then this year we're implementing GASB 87, and that's the lease accounting GASB. And then they also consider the probability of fraud. And then they talk about the audit procedures that they're going to do that will specifically address the risk of fraud. So does the committee have any questions concerning the pre-audit letter? Oh, Councilmember Jurinsky, do you have any questions on that?
No.
Okay. Yeah, I thank you for the explanation of the two letters. That is appreciated. I don't think I had any questions on that. So thank you.
Sure. Thank you.
Okay, well, we're moving right along. Okay, investment portfolio review, Teresa.
Good afternoon. The city invests its portfolio, its investment portfolio, pursuant to an investment policy, which you have all seen. It is managed externally by an investment advisor, which is Insight Investment. And Mary Donovan is our advisor, and she's here to walk you through the city's investments. So Mary, I'll hand it off to you. Thank you.
Terrific. Thank you very much for the opportunity to be part of this meeting and to share information with you on the portfolio. So in the package of information that you're working your way through, if you wanted to look at page number 120, we have some information on the portfolio, some graphics and whatnot that'll help us in our discussion. And we're really looking at the portfolio as of a point in time, which would be the holdings as of February 28th. So as we work our way through it, if there's something that piques your curiosity or you want to pause and talk about, I'm really happy to do that. But on page number 120, starting with the portfolio overview, it just gives you some broad diversification information on the portfolio with respect to the asset classes that we're invested in. There is a component. Yes.
Can I interrupt for just a second? Since it sounds like some of our committee members did not get the packet or have a chance to download it, could we ask you to share the screen, please?
I was just going to say that. Thank you.
And you might need to get permission from Tammy. Tammy, can you help?
Let's see. I wonder, did I notice that Andrew was on the line? Andrew's usually very helpful in sharing the screen.
I can display it if you'd like. I can, if you want, I start on page 120.
Yeah, that's where we start. Mm-hmm.
Okay. Can you see my screen?
I cannot.
Okay, just a moment.
In fact, while we're waiting, I was just going to ask, do we not normally have like the presentations pop up?
We don't necessarily broadcast everything since we've generally thought that council members had the packet, but we are more than happy to do that.
No, I had the packet, but wasn't some of it PowerPoint?
I don't think so up to this point.
Oh, maybe it's later then. Okay.
And I do have the packet. I mean, I have it pulled up now, but is there any reason why it can't be put in eScribe?
That's a great question. That's something that I'll have to follow up with others about that, because that's not something that I'm aware that we're supposed to do, but we can definitely follow up on it.
Yeah, I think on PED, I think we do have it on eScribe, but I think there's another committee where it's not going on eScribe as well. Maybe Kate, I don't know. Katie, are you still here? Maybe not.
I don't see her in the list.
Oh, okay, well, we can check into it later.
We'll definitely follow up with Katie and find out. But you should be able to see it now.
Oh,
Thank you, Andrew.
This is what I saw in the backup. Yeah.
Terrific. Thank you for getting that on the screen. It definitely will facilitate the conversation. So with respect to the broad diversification of the portfolio, categories that we would want to draw your attention to, there's a cash component that's currently running at about 8% of the portfolio. Again, this is as of February 28th. Then the next categories on the grid would be the corporate exposure, and between our domestic and our international exposure, we have approximately 28% of the portfolio invested in credit-related securities. The largest allocations in the portfolio go towards federal government securities in the form of treasuries and U.S. agency bonds, and that comprises about 55% of the portfolio allocation. And then the remainder is a 10% allocation in municipal securities. So overall, the weighted average maturity of the portfolio comes in at about 1.6 years as of February 28th. And the portfolio size is running at 996 million in invested assets in the form of the par value of the securities. So over the last year, when we think about the way the portfolio has changed, there's been some modest shifting amongst the categories, but the largest change was frankly with an increase for our treasury exposure. So we've been adding treasuries to the portfolio, and we've been trying to extend duration. So our duration extensions are going to primarily come from the agency and treasury exposure. So that's kind of a broad theme to keep in mind when we're thinking about what's been happening in the portfolio over the last year. On the next page, we have a look.
Can I ask a question on that one?
Absolutely.
So you said we're adding to our treasury. 55% of the portfolio is in that category. Is that typical of municipalities to have this type of distribution?
It really is. The 55% is a combination of treasuries and agency securities, but that is really the mainstay of public sector investing. Colorado state statute allows for up to 50% of the portfolio to be invested in credit-related securities. We have about a 30% allocation, so we have room to extend in our corporate sector. But strategically, we've been very interested in trying to extend the maturities of the investments that we're purchasing because interest rates are quite attractive right now. And our corporate exposure is limited to a 3-year maturity, whereas we have more flexibility to extend in our government-related securities. So there's a couple of reasons for the focus on the governmental side of it, but I would say in general, yes, treasuries and agencies are the mainstay of public investing, and that's quite typical from what we see across the country.
Okay, great. Thank you.
With respect to the maturity distribution on this next page, you'll notice that the portfolio is structured so that it's going to be providing quite a bit of flexibility in the form of liquidity. In fact, within the next year, approximately 35% of the portfolio will mature, and with the city's portfolio size, that comes out to about $350 million that will be maturing. Those funds would then be available to meet operating needs and expenses, or potentially to be reinvested out the yield curve again. So that's encouraging. We've also been, as I mentioned, building out that longer end of the portfolio. You see that in the 3 to 4 year and the 4 to 5 year category. And over the last year, that exposure has increased by almost 100 million. So we've made good progress in trying to extend and lock in some of the higher yields that are available in the marketplace at this time. The maturity allocation map just gives you the view of where these types of securities are located on the maturity horizon. Our longest exposure is in the treasury sector. It's running with an average maturity of 2.3 years. The next longest is the agency sector at 1.8 years. So we have a little bit shorter exposure with respect to our corporate securities and our municipal bonds as well. So again, trying to manage that duration exposure, it's really a critical factor for future performance. And then on the next pages, we're going to actually see the securities that are in the portfolio. And there's a lot of data here, and I'm not suggesting that we scrub this line by line, but it's going to be, I think, maybe just kind of interesting. I mean, you have right off the bat, your cash allocation. There's a couple of cash vehicles that we use in the portfolio, comprising that 75 million. So that cash number fluctuates, right? Depending upon spending needs, it can be coming down or increasing in expectation for accumulating cash for spending. So that's a piece of the portfolio. Cash levels, cash rates are really quite attractive. So that's a additive to portfolio return at this time. Then we move into our treasury ladder, and the maturity date for the securities that are held in the portfolio is the fourth column in. It starts with April 15 of 23 for treasuries. A lot of these first treasuries listed are securities that were bought when interest rates were a lot lower back in 2020, 2021. These shorter term treasuries will be maturing and reinvested at higher rates. You'll start seeing some of the better yields that we've been able to add as we get to the bottom of the ladder on this page, and importantly, maybe even more on the next page when we look at some of the treasuries that have been brought into the portfolio in 2022 and 2023 with yields from 3% up to 4.30-ish kind of yields. So our average yield at this point on our treasury exposure is about 2.25%. And again, that's an improving number as lower yielding securities purchased days gone by are finally starting to mature, and we're able to reposition those assets in this current rate environment. So some cash was allocated to the term investments in March just as part of typical and routine portfolio management, evaluating liquidity needs and determining if there's flexibility to invest. And indeed, there was flexibility, and about 20 million of new funds were purchased in securities maturing in January of 28. Again, that's pushing out to that 5-year horizon, and then in an agency to October of 26. So again, the theme I'm trying to drive home is again that idea of trying to extend some of these assets a little further out on the yield curve so that we'll have the benefit of these better yields that we're seeing now and for earning potential in the future. So that is a pretty exciting thing for the portfolio, frankly. The next bucket of securities listed on the report are the agency securities. And again, if you would like to just move on to that next page, you get to the end of the agency ladder of the activity that's been going on in 2022 and 2023. Yields, again, coming in that high threes up to about a 4.35 yield for some of the agency exposure. Really very attractive maturities ranging anywhere from 3 years to about 4 3/4 years. So again, trying to make that duration management execution for the portfolio. So that's been going really quite well. Really pleased that we've been able to participate as much as we have. And that's a real statement to the city's solid knowledge and understanding of the cash flow needs that are met through the liquidity in the portfolio. So, I mean, that's a really critical piece of the puzzle, is that understanding. So the next section of the report gets into the corporate securities, and we have a couple of ways that we're going to look at this in the report. So I don't want you to feel like we're moving through it too quickly, but the corporate allocation has been a really helpful tool for adding incremental yield. So the spreads into corporate securities at times can be really quite attractive. As an example of a recent purchase here in March, we actually are just looking for the Toyota exposure to mature on March 30th. And we have reinvested that 5 million par value in John Deere, moving into more of an industrial name to the right out to the 3-year horizon as far as we can really go in our corporate sector. And that came into the portfolio at a yield of a 4.26. So that's a solid single A credit, and the investment policy is flexible. It allows us to participate in the single A credits, and we are grateful for that flexibility. It gives us an opportunity to have access to a broader universe of names, which improves diversification in the portfolio and helps us to manage risk. So the corporate sector is, although we have room to add, we are very selective, and we don't just add in order to add. So running now with about a 30% exposure, but we'll certainly be interested in continuing to look at those alternatives for the portfolio as well. In addition to the domestic bonds, which are by far the largest portion of our corporate allocation, there is a small piece of Australian exposure in the portfolio. We do have the flexibility to buy Australian issued securities, dollar denominated, no foreign exchange going on with the investments in the portfolio. And the Canadian financials are actually really quite highly rated. So that's an area that we may look to more in the future. But we have been favoring the Canadian exposure for our international segment of the portfolio. In particular, the Royal Bank of Canada and Toronto Dominion are a couple of very strong names that we have been happy to add. And our corporate allocation in the international sector is running at about 6% of the portfolio. So we do have flexibility there. We can extend to a 10% allocation for Canada and a 10% allocation for Australia. But we've been very selective again in managing our corporate sector in general and our international exposure as well, particularly in the period of volatility that we've been working our way through here as of late. So our Canadian exposure, though, and the Australian to a lesser degree has been a nice way certainly to add some incremental yield. And the Canadian exposure is really very, very highly correlated from an economic perspective to the United States. With respect to the municipal sector, which is that last bucket that we have here on the page, that is currently running at about a 10% allocation. And over the last year, we actually were able to source a couple of nice opportunities for the portfolio in the form of Wisconsin state GO paper and then also Maryland state. And we are looking at taxable, primarily general obligation bonds, but we certainly have the flexibility to purchase revenue bonds as well. And we do own Massachusetts Water Resources, which is a revenue issue. But, you know, we are very mindful of volatility and perceived credit risk. So we do enjoy adding those taxable GO levels, particularly at the state issuance. So that's been a very productive sector of the portfolio as well. And all of these things combined bring us into an average yield in the portfolio of about 2.16% as of February 28th, an average maturity in the portfolio of 1.6 years. And then as of right now, our duration is just a hair longer, but it does roll in fairly quickly given the size of the portfolio. So we're working to maintain and extend that marginally as liquidity allows. So the next page, just to give you a more of a summary view, diversification in the portfolio. We've got the issues in the portfolio here by issuer. And right off the top, again, you're back to thinking about treasuries as our single largest allocation in the portfolio, followed by our agency issues. So, you know, point being, this is, although there is a 30% credit allocation in the portfolio, this is a very, very strong credit quality portfolio. So we have a really good fundamental base built with our credit risk-free treasury securities, agencies following that. And then we are bound by a 3% diversification requirement for investment policy for any corporate issuers. And our single largest name in the portfolio in corporates as of February 28th was Toyota, and that was running at 2.66%. And then the diversification gets even more granular from there as we work down to some of the other names in the portfolio. So again, very high credit quality, very well diversified amongst issuers. And then we have made really good efforts on diversifying across the yield curve, locking in some of these higher yields. And we'll certainly continue to do that, as that is very fundamental to the strategy given where we are in the interest rate cycle.
Are there any concerns? You know, there's quite a few banks in here. Are there any concerns with just what's going on with some of the recent news?
Right. Honestly, I'd like to reassure you that the names in the portfolio are very, very strong, and we are not in a position where we're looking at a very regional bank that does not enjoy diversification. That was one of the fundamental issues associated with the banks that were suffering here domestically over the last several weeks. A real high concentration of customers in a particular category has led to some risk management issues at those institutions. Primarily, our heaviest allocations are coming in with some of the very large banks that are very well diversified and very heavily scrutinized. Another factor to keep in mind with those smaller regionals. Really, when we're thinking about credit exposure, I think U.S. Bank is the only one that we have at this point that's on a negative outlook, and they've been on negative outlook for about a year and a half in response to some acquisitions that the bank was making. So we haven't had the same kind of issues with our holdings that we've seen with some of those particular regional banks. And in general, the banking sector here in the US is considered to be really in pretty good shape. So.
Great. I had a question. When you mentioned the municipalities with the general obligation, that you said something about they're taxable.
They are, the issues that we're purchasing are taxable. And I'm drawing a distinction there between the issuance of taxable or tax exempt debt. The tax exempt issues have a lower yield associated with them because they have the tax benefit for the holder of the security. So we favor the taxable issues because the city is not a taxable entity. You get no benefit from the tax exempt status of the bonds. And so we are maximizing yield in the taxable space.
Okay, that makes sense. Thank you.
Cool. So that's what I wanted to cover with you, but I'm really happy to talk about this all afternoon if you'd like. So if there's anything else that you'd like to talk about with it, please don't hesitate.
Thank you. You can tell you're very passionate about that, all the numbers that are making us dizzy. Councilmember Jurinsky, any questions on the presentation?
No, I don't have any.
And then just on the cash that you mentioned, is that our reserves?
This is everything, Councilmember Bergan. This is reserves. This is all of our funds that are invested. So whether they be reserves or cash within each fund of the city, including water, they're all combined and then they're invested together.
Okay, great. Thank you. All right.
Just as one more FYI, we do meet quarterly with our investment committee. We also invite members from this committee to that meeting. So far, we've not had a meeting with the new council members that have been appointed, but you're more than welcome to attend, and we'll bring that up to Councilmember Zvonek as well.
Yeah, I think he mentioned, I think he's planning to be at the quarterly meetings.
Oh, wonderful.
I'm pretty sure that's what he had told me. If I recall, don't you do like a 7:30 in the morning meeting?
I know, we try not to follow a council meeting.
Does it follow council on a Tuesday or no?
I think it's more on Thursdays. We just, pick a date that works for most of the committee members since they're appointed or appointed by this committee. We just try to work on their schedule.
Okay, very
Terry,
good. Yeah, I think Dustin was interested. Oh,
Terry, can you make sure that we all know when they are?
Sure.
Thank you.
Okay. All right, and then thank you very much for the presentation, and we'll move on to the debt book update.
Yes, good afternoon again. We included a debt book in your packet. I understand maybe you don't have the packet, so I don't know whether you want it displayed or not. I was not planning to go through it on a page-by-page basis, but I will let you know I'm going to summarize what's in the debt book. We have a debt book that is produced by our financial advisor on an annual basis, and it lists all of our outstanding obligations. It's arranged by category and lists outstanding certificates of participation first. Then it has our capital lease debt, which is typically smaller deals that aren't publicly issued, but they are debt nonetheless. It shows our enterprise revenue-backed debt, which would be water and sewer, and obligations of golf courses, general improvement districts, Aurora Urban Renewal Authority, and the like. After this summary page, Andrew, if you'll go to the next page, which summarizes there we go, all of our outstanding debt. You can see the original principal, which is it's a little small, but the outstanding principal, when the maturity is, and etc. So this is just a look at the overall debt portfolio of the city and its component units. And after that, the book goes through detail related to each transaction in the further pages. It also includes graphical representations of our debt by category, A lot of this information in this book is utilized to answer questions about what debt capacity we have. So you'll see it ties into what we have shown you in the past as far as total outstanding debt and what we have coming up as far as maturities and what capacity that may allow us. The book does not include issues that were closed this year, but it does include obligations which were issued in 2022. In 2022, we issued 31.9 million certificates of participation for road improvement projects. We did a lease of 6.176 million for rolling stock and 20.64 million for the refinancing of the Hyatt at the Fitzsimmons campus. So in addition to that detail, it also shows remaining amortization schedules. If you want to dive a little bit deeper into each outstanding transaction, it includes ratings reports on our credits. And this is an overall good resource if you want to understand our debt portfolio a little bit better. This is an information only item. I would encourage you to look at this at your leisure as you are interested, and I am happy to answer any questions you might have in this regard.
I think in reading it, we looked like we were in a very good position in terms of our credit.
Aurora enjoys a very high credit rating, and that serves us well in the market because investors like those higher credit transactions, and we get a lot of respect and interest in the market due to our high credit ratings.
Is it AA or I think, well, Moody's is there. Are we rated AA typically?
I'm sorry, we are in the AA category typically. They did assign us, we do have a AAA issuer rating, and that is because we don't have any general obligation debt outstanding. That would be, if we did have general obligation debt outstanding, we would be AAA. The debt that we have at the city level is typically all appropriation credit, and the appropriation credits, because they're allocated in the annual budget, are a tier lower than the general obligation debt. So they're all in the AA category.
So if we had general obligation debt, we would be rated higher?
The general obligation debt itself would be rated AAA.
Oh, okay.
Yeah.
Okay.
Just to add to this, Councilmember Bergan, just so you know that, when we look at this AAA rating of the city, that's our underlying rating, which really speaks to the financial strength of the city as a whole, which is the important factor here, is that our underlying credit rating is very, very strong. It's the highest rating you can receive. And when you issue COPs, a lot of times that does lower the rating because of the type of debt that it is. A
Right.
COP is kind of considered a little bit less secure.
Because you have to pledge assets.
You usually have to pledge assets, but it's also subject to annual appropriation.
Okay.
So that's a reason why that they usually lower about, a notch or so in the rating process.
When we do issue COPs, you look at what that entire amount that we currently have is, and if we add on to it, what the ratio would be, right, for the whole entire.
That's the process we have undertaken when we've talked about debt capacity with you all, when we're talking about certain initiatives that we would like to do. Yes, absolutely. So you can see as the debt amortizes, it allows for you to put more debt in the books. That's qualified, however, because certificates of participation have to have an underlying asset. So we're a little bit limited because we have only a certain number of assets that don't have an existing lien on them. So yes, but this is the information that we've shared with you in prior sessions.
Thank you. Councilmember Jurinsky, do you have any questions or comments?
No, I don't have anything.
Okay.
Thank you.
Thank you. Appreciate it. I think that's it, other than miscellaneous matters. Is there anything that needs to be brought up? No? Okay. So we're set for the next meeting on April 25th at 1 p.m. And I think we may have to make some adjustments there for the time, but I think Councilmember Zvonek will coordinate that if need be.
Okay, thank you.
Right now,
Okay.
can we hold 3 p.m. on the 25th and we'll confirm with Councilmember Zvonek?
Okay.
Okay.
3 p.m. April 25th. Okay, very good. All right. Is there anything else from anybody? All right. Well, then we will adjourn the meeting and appreciate everyone's time.
Thank
Have a
you.
good afternoon.
Well.
Bye.
Bye.